The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.
Well, joining us now here on the program every few weeks or every couple of months, we always like to kind of sit down and have a broad discussion on what's going on, not only in the ag economy and the markets, but the broader economy and more. And we like to kind of hone in on some different things that need to be paid attention to here throughout the markets. So joining us for that conversation, we always like to talk with David Widmar, economist with Agricultural Economic Insights. And David, welcome back to Market Talk. It's always good to catch up with you. Thanks for joining us.
Well, thank you, Jesse. Always great to chat.
Well, let's just start broadly real quick. I know we got a few different topics to cover, but kind of looking at this market environment in the grains, in the livestock, everything, it kind of feels like we've gone a little sideways here. I know we have some bigger reports coming at the end of March, prospective plantings, quarterly grade stocks. We got, spring field work starting in many parts of the country. I guess let's just set us up, your perspective, 1,000-foot view of kind of how this market environment's looking right now. Do you feel it's kind of gone sideways to some degree, David?
Yeah, we're definitely, moving out of this winter mode into more of a production mode. So once we start to see, especially on the crops, once we start seeing progress or, scores of how good the wheat crop is, crop conditions. Once we see planting progress, once we get this prospective planting report, the market's going to shift into how big is 2024 production going to be. But right now, we've seemed to have caught our breath. And this came after 6 to 8 weeks of just not a lot of good news, especially on corn and soybeans. Those commodity prices just ticked lower pretty consistently in January and February. And much to producers' frustrations, there wasn't a whole lot of bad news out there. There wasn't necessarily good news, but there was a lot of market movement for a little bit of new information being developed. So we're switching gears here. We're going to start focusing on 2024, and we'll see how that shapes up.
Well, I know you're working on something right now that it's very interesting. I want to talk about this, and I know it's going to be released here soon on the AEI.ag website, but you're looking at ending stocks here. So kind of give us the overview of what exactly you're working on and some of the findings that you are finding here, David.
Well, ending stocks are important. There's been a lot of conversation around corn ending stocks, at 15% for the 23-24 marketing year, maybe even bigger based on those USDA early projections for 24-25. And that's helpful, but we need to think about the forest rather than just the individual trees. And so what we do on a pretty regular basis here is we say, these are the 13 primary crops in the United States. Let's take those bushels of ending stocks and convert them into acres worth of production. And that gives us something that we can add up. And so what we have here in the United States is around 38 million acres worth of ending stocks. And now all of a sudden we can compare this over time. We know, for example, from a year ago, we had about 30 million acres worth of stocks. So we saw a pretty big increase, about 7.5 million acres worth of additional stocks, and 60% of that came from corn alone. So corn has been the real driver here, followed by wheat. And then I think the other thing is we can step back and say, well, how does these conditions compare over time? So interestingly, the U.S. stock situation, again, across all crops is slightly below the long-run average. And one of the big implications of that is we might be able to reallocate in the acreage story here in 2024, some of those acres around to take some of that burden out of corn. What we really want to avoid is a situation like 2019, and that's when corn stocks were really high, soybean stocks were really high, wheat stocks were really high, and we had 60 million acres worth of ending stocks. So far, we've been able to avoid that really bad situation in soybeans and wheat, but we have to keep our eye on that because that could be a real game changer and a real frustrations for the market if we have abundant stocks in multiple crops and we can't reallocate acreage to alleviate that pressure.
Well, to your point there and some of the work you're working through and your findings, I mean, thinking about spring acreage, could we see a substantial shift here? I mean, we're kind of at that point. I know a lot of folks did some field work in the fall to prep for, say, corn planting, but just the way the market dynamics have shifted, et cetera. I mean, I guess what are you finding? What are you hearing? Could we see a substantial shift in acreage here this spring?
Well, we'll of course always keep our eye on that. That prospective plantings report that comes out in the end of March is important, but and we're all laser focused on that. But let's talk about two things that will ultimately one thing that we know and one thing we don't know, and we won't know for a while. The one thing that we know is we planted fewer acres of winter wheat based on that January winter wheat seedings report. About 2.6 million fewer acres of wheat. What's going to happen with those acres? Well, they're going to find their way into production of something else. Maybe it's corn or sorghum or soybeans, but we're seeing wheat production push its acreage into other crops. That could be a little bit of a headache. The other thing we don't know is, of course, Mother Nature bats last. We could have prevent plant that comes in below average or above average, and that could ultimately impact the acreage situation. But in general, soybeans, and we've written a little bit about this, have much more appeal in 2024 than they did a year ago. And with that in mind, we expect that soybeans will grab a little bit larger slice of that corn soybean pie as we go to allocate that.
I'm wondering too on this ending stocks conversation, David. There's been a lot of folks who've talked about the world ending stocks picture as well. Are you doing any work on that, or have any thoughts in general on just that world ending stocks outlook right now for grains and more?
Well, Jesse, yeah, we use that same method and we apply that to the world situation. And I'll be honest with you, it's still a very tight situation in the world. And the little asterisk that we have to put next to that is tight because we are not considering China. China has about half of all the world stocks right now of all the grains. So if we, again, take all the grains, put them in acres and say, where are these acres of stocks sitting at? The United States has, you know, I think it was around 38 million acres worth of stocks. China has somewhere around 300 million acres worth of stocks. They have a huge corner on these stocks, and I don't know what the implications of that are. One of the things to keep in mind here is those acres and those stocks in China, those acres worth of stocks, they generally aren't moved onto the market, so they're kind of out of the trade or the global trade picture. The other thing to keep in mind is so we have a tight situation globally when you remove the China stock situation. That's maybe favorable for commodity prices, especially for trading of exports. But I think the final thing to keep in mind is ending stocks in a place like China is really, really hard to measure. All the errors tend to aggregate there. And so while we can be very confident about the US stock situation because we have those quarterly stocks reports, it gets much more difficult in other parts of the world if we don't have an accurate measure of what those stocks are. So again, the global picture, you can look at the data in a lot of different ways and get different conclusions. Our conclusion is it's tight, but it's tight for the trade situation because of China and those stocks that they have on the books in their storage.
Speaking to China here, real quick, since you brought it up, I know there's been a lot of questions about the Chinese economy. Chinese pork production, for instance, has been something that's been watched. China's been in here canceling a lot of their recent wheat purchases as well, just in the last week to 10 days. I mean, between U.S. SRW, French wheat, Australian wheat now as well. I mean, to your point, I mean, China has a lot of stocks here, so what exactly is going on there? I mean, are they canceling to find stuff cheaper? Are they feeling like they have enough? Maybe I don't know. I'm kind of hypothesizing here, but any other thoughts to some of those things with China in mind?
I think the key takeaway here is as decision makers, we have to decide um, what it is we're going to keep our eye on and what it is we're going to want to speculate on. It's kind of like lining up a two at the football, both the offense and defense, and the quarterback's making all sorts of noise to try to get the other team to go off sides. And the idea here is you got to keep your eye on the ball and move when you see the ball move. And I think one of the things to keep an eye on is it's the shipment of commodities that are moving. China actually, interesting, bought $30 billion worth of ag products, which is the third highest that we've seen in history. It's down quite a bit from where we were the last few years, but the dollar of activity was pretty strong. But when you dive even deeper, their soybean purchases on a quantity basis really slowed up. And December and January. Keep in mind they're trying to buy the cheapest and grain from around the world they can procure. Some of that's grain prices, some of that's exchange rates, and some of that's logistics. And so China is always looking for the cheapest grain around the world. And I think that we as individuals kind of have to process that and tune out a lot of that noise and not try to get too speculative about China's motives and just look at the market that's the data that's in front of us and make the best decision we can today.
Well, we are joined today by David Widmar, economist with Agricultural Economic Insights. You can find them online, aei.ag. David, let's flip gears a little bit and talk the macro picture here. U.S. economy. We've seen hotter than expected CPI and PPI data out here this past week. The PPI number on Thursday, I think, was about double what the trade expected. Sticky inflation is kind of the term that's thrown around a lot here as of late. I guess, broadly speaking, your thoughts on this whole macro picture, how it's influencing not only consumers but also the ag economy as well here, David. What's your thoughts?
Well, I think the first thought to keep in mind is we've gone a long way with inflation compared to a year or 18 months ago, a really big turnaround. And so we're sort of sticky, but we're sticky in between that in that 3 to 4% window. A lot of that data has been stuck in there, and of course, it takes a lot of time to really figure out which way it's going to be moving. So we're sticky, but we haven't quite seen this reversal of levels that was much more concerning from a year ago. So the 30,000-foot picture is it's still a positive story. The more nuanced story, the details, the devil's always in the details, is we probably still have a long ways to go with respect to getting inflation back to the Fed's goal of 2%. I didn't think the Fed knew this was definitely a possibility when they talked about potential rate cuts in 2024. But I think, as most of us know, we need to wait. The Fed's unlikely to cut rates right away here in 2024. And so we're going to see this have to play out. We got to keep an eye on the economy. One of the things that's giving the Fed a lot of cover to fight inflation so far is low unemployment rates. And so these low unemployment rates signal the economy still doing fairly strong. It's been fairly resilient. So we'll have to keep an eye on that. The last thing I'll mention is we've talked a lot about the Fed raising and lowering interest rates. They have another tool that they've been using to spur the economy and then to slow it down. It's their balance sheet, and they're still working that balance sheet lower. I think one of the things we're keeping an eye on for 2024 is, do they give some guidance, some forward guidance as to what their balance sheet reduction plan looks like? Of course, that is another way that they're regulating the economy to the tool in their toolbox. And so while we haven't seen interest rates move for a while, they're still shrinking that balance sheet. And we'll see how they play that out here in 2024.
I think in terms of the farmer rancher perspective, David, I know a lot of farmers and ranchers look at the interest rate environment and things like storage costs and input costs and buying new equipment or not, or leasing or operating loans, things like that. And I feel like that whole situation and aspect here tied with interest rates, it probably just kind of has to come back to knowing your costs of production, knowing your break evens, and making sure you have a good plan in place on your operation, right?
Yes, of course. And one of the biggest frustrations I have right now, I think what you were trying to, another way of summarizing what you said is, get specific. Stop talking about general, vague situations. Get specific about your operation and the implications for your business. One of my biggest pet peeves right now is we're talking about interest rates. Well, interest rates for what? Is it for a line of credit? Is it for a new farm? Is it for a new piece of equipment? Oftentimes, it's these long-term rates that the farm economy is most sensitive to. And we have a situation where I think in 2024, we have an inverted yield curve. And let's move beyond this speculation about maybe it being an indicator for a recession, but let's think about the implications for a producer. That means that short-term money costs more than long-term money. That means your line of credit's going to cost probably more than a tractor note or maybe a farmland note. And at a minimum, that relationship between those debt costs are out of whack, out of normal. So what does that mean? Well, even if the Fed lowers short-term rates and short-term money gets cheaper, these long-term rates, as you started this off, Jesse, could be sticky. They could actually resist this downward movement if it comes to fruition. So I think we still have a lot of unknowns and a lot of risk here in long-term money, and producers need to kind of avoid speculating or betting against the Fed and the Fed actions. Get specific about your operation, know your details, and make decisions based on what you know as a fact today, and limit that speculation about what might be going or coming down the pipe down the road.
David, I know you and the AEI team been doing some work on crop insurance. Obviously, a pertinent topic right now. Got ARC PLC deadlines here on the 15th. But just looking at crop insurance, where some of these prices have settled out here for this growing season. I mean, I guess give us your thoughts on this crop insurance environment right now, David.
Yeah, one of the big takeaways we're trying to remind producers of is think about your budgets, what your costs of production are, as you teed up earlier, Jesse, but also where that insurance coverage is and what's that difference. And we have a situation here. The producers have this worst case scenario where they're going to have to rely on crop insurance because maybe it's a drought or even just adverse planting conditions. That exposure between what crop insurance covers and what those total economic budgets costs are, and each farm is going to have a different cost of production. That exposure in those economic budgets that we follow is on a dollar basis the biggest that we've seen in history. So what does that mean? That producers have a lot of skin in the game coming up this year. And so we need to think about this not necessarily on a percentage basis, because producers are saying, oh, I have 80% coverage or 75% coverage. Well, how costly, how many dollars is that 80% coverage? And what we have going on here today is it's still a high cost of production. It's improved, it's came down a little bit, but it's historically high cost of production. And with that comes historically high table stakes. And producers are going to feel that. And of course, what are the implications for their balance sheets? Because if they have a hiccup, they're going to need that balance sheet to absorb some of those losses.
Well, great thoughts, David. Before we wrap it up here, any other thoughts, things that you guys are working on or watching, input costs, land prices, stuff like that? I know you guys track a lot of things. Anything else you want to talk about or mention here today?
I had a great question earlier this week from one of our readers, and they were talking about China not buying corn, but yet there's still some maybe positive news around corn exports. Who's buying these commodities? And so we're working on an idea here, is looking at, we get a lot of focus on China buying, China not buying, but we have a lot of grain buyers and we have a lot of corn buyers. And one of the things that we've seen from a year ago, looking at the last 3 months of 2023 and the first month of 2024, comparing that to the year before, sort of a quick back of the envelope calculations showing countries like Canada and Mexico and Japan, these are important trade partners for corn, and they've been stepping up because of lower commodity prices, more availability. And so we have been seeing corn exports, not out of the park home runs, nothing to write home about, but we're seeing this usage story start to trend higher. And that's ultimately what we're going to need to do to work our way through this tight stock situation. A year ago, high prices were rationing, and that was important. Today, we need to see lower prices usher in more usage. And so we'll see at what price point that takes place. But let's keep our eye on, China's important, but let's not singularly focus on China. There's a lot of other uses out there, both domestically and internationally.
I'm glad you brought that up because I've said that for a while now as well. We have other trade partners besides China. China always gets the attention, but to your point, Canada, Mexico, countries in Latin America, Southeast Asia, et cetera, et cetera. Some of our European trade partners. I mean, and I know the work that a lot of our various trade organizations and more do, whether it's grains or livestock, there's a lot of these other countries that, maybe as the deck chairs have shifted around a little bit, as I've used that term before, and, China maybe goes to South America more. Well, okay, that gives opportunity for us to expand and work with other markets. And I think that's at the heart of what you're talking about, David.
Yeah, we need to see record usage to both corn and soybeans. So we're going to be excited about that when it comes. But in the meantime, we need to see record usage, and it's going to take, probably some combination of domestic activity, but also all of these international partners. It'd be nice to have China there, but it's going to take all of our international partners to get there. So we'll see how that plays out.
Well, really appreciate the thoughts and the insight. Give us a plug real quick for the AEI website, the AEI Premium version as well. You guys have so much great content. I want to make sure folks go check it out. So give us the details on that, David.
like today's conversation, we're always trying to break down some of the biggest stories that are on producers' minds and that folks in production ag are thinking about. And we do that with a lot of historical data, a lot of economic frameworks and analysis to help ultimately the decision maker and those that are in production agriculture. So feel free to check out our website, aei.ag. We have a free Monday newsletter, and then we have a subscription to content and charts and data. And again, it's ultimately to help you, the decision maker, make those better decisions.
AEI.ag for more information. With that, David Widmar with Agricultural Economic Insights. David, always a pleasure to talk with you, sir. Have a great one, and we will get you back on the show again soon.
Thanks, Jesse.